June 6, 2026. Enterprise Finance and FinTech Sector Update. 10 Top Stories Driving Markets and Tech. A global roundup of innovative shifts in corporate finance, risk management, payments, compliance, and market infrastructure, with a futurist twist and optimism for the road ahead. 1. Corporate treasurers embrace stablecoins. Digital dollars go mainstream as CFOs seek borderless liquidity boost. Corporate finance is witnessing a watershed moment as stablecoins transition from fringe crypto curiosities to mainstream cash management tools. In a decisive shift, many Fortune 500 companies' treasury departments have begun using regulated stablecoins, cryptocurrencies pegged to fiat currencies, for cross-border transactions and liquidity management. This week, a global survey of CFOs revealed that an overwhelming majority of large enterprises plan to integrate stablecoins into their cash flow operations within the next 18 months, citing benefits like instant settlement, lower fees, and round-the-clock operability. Transaction data underscores this mainstream momentum. The total value of stablecoin payments in the past year approached an astonishing $11 trillion, putting it in the same league as global card networks. Corporate treasurers, once cautious, now see digital dollars as a vital instrument to move money quickly across borders, as easily as data flows, aiming to increase efficiency in a high-interest, post-inflation world and keep their financial operations orbiting smoothly. Behind this rapid mainstreaming are clearer regulatory guardrails and high-profile adoption stories signaling that stablecoins are here to stay. In the United States, new legislation, the so-called Genius Act, signed in 2025, has established a federal framework for payment stablecoins, providing companies and banks the legal clarity to hold and transact with these digital assets. Meanwhile, Europe's markets in crypto assets, MiCA, regulations have similarly been rolled out, solidifying licensing requirements and consumer protections for stablecoin issuers and users. With these laws now in effect, major payment networks and banks have come aboard. Visa's CEO reported that Visa's own network handled billions of dollars in stablecoin settlements last quarter, proof that the old and new financial systems are converging. This confluence of regulatory green lights and proven corporate use cases has transformed stablecoins from a speculative idea into practical infrastructure for international commerce. The embrace of stablecoins is often likened to connecting financial markets as seamlessly as a satellite network around the globe, even hinting at a future where cross-planetary commerce might be feasible. The human benefit is clear even today. For businesses large and small, stablecoins enable near-instant payments to international suppliers or remote employees without waiting days for bank wires to clear or paying exorbitant FX markups. Finance chiefs and treasurers describe stablecoins as giving them real-time control over global liquidity. But they also caution that risk management must evolve. Robust safeguards are needed to manage volatility, counterparty risk, and cybersecurity when dabbling in digital assets. With those challenges in mind, industry optimism remains high. As one Fortune 100 CFO put it, "We can now move money at the speed of the internet. That's a game changer, provided we have the rigorous controls in place to keep trust in the system." In effect, stablecoins have begun doing for corporate cash what email did for communication, erasing borders and time zones, ultimately empowering people and businesses with faster, more inclusive financial networks. E-commerce and legal compliance angle. For e-commerce businesses, the mainstreaming of stablecoins opens up the prospect of faster cross-border customer payments and supplier settlements. Merchants selling internationally might soon accept stablecoin payments with the confidence that funds will settle in seconds, improving cash flow and customer experience. However, with this opportunity comes regulatory responsibility. Online retailers and payment processors that embrace stablecoins must comply with evolving laws, such as new stablecoin licensing requirements and anti-money laundering (AML) standards established by the recent U.S. Stablecoin Act and EU crypto regulations. In practice, this means implementing robust identity verification (KYC) and transaction monitoring tools to ensure that digital currency payments are above board. While compliance adds complexity, it's also a path to greater trust in e-commerce. reassuring customers and authorities that even futuristic payment options won't compromise security or consumer protection. 2. Enterprise risk management leans into AI. Real-time risk monitoring becomes mission control for corporate stability. Global corporations are investing in advanced risk management technology at an unprecedented pace as they navigate a world of complex, fast-moving threats. This week, financial industry leaders at a major risk tech summit in Singapore highlighted how AI-powered risk platforms are reshaping enterprise risk management, ERM. A consensus is emerging that companies must shift from static risk registers to continuous, predictive risk radar systems. Equipped with machine learning models and data streams spanning everything from supply chains to cybersecurity events, these platforms can spot emerging issues in real time, akin to a space mission control scanning for anomalies. CFOs and risk officers report that artificial intelligence and big data analytics allow them to simulate scenarios and stress test exposures faster, transforming risk management from a backward-looking compliance task into a forward-looking strategic function. As one risk analytics director put it, these systems let us see around corners. Identifying potential problems before they escalate means we can take action early and keep our businesses steady on course. This push also comes from rising pressure by regulators and boards worldwide to improve oversight. Recent regulatory guidance in multiple regions, including new operational resilience rules in Europe and Asia, now calls for integrated risk governance, where financial, operational, and third-party risks are managed holistically rather than in silos. In response, global banks in Asia and Europe confirmed they are merging their vendor risk, cyber risk, and fraud detection units into unified risk command centers, often powered by centralized data and AI insight tools. Such integration helps organizations see connections between different risk types, for example, how a vendor's cybersecurity vulnerability could create financial and reputational risk simultaneously. Experts at the summit noted that the modern enterprise risk manager increasingly resembles a systems engineer, balancing a vast network of internal and external risk factors using sophisticated digital dashboards, similar to how an astronaut monitors life support, navigation, and system health all at once in a spacecraft. From a people perspective, the tone is optimistic. Rather than replace human judgment, the new AI-driven risk platforms are freeing human experts to focus on strategy and decision-making. Routine detection of anomalies, such as unusual financial transactions, supply chain delays, or compliance red flags, can be largely automated now. This leaves risk teams with more bandwidth to craft contingency plans and provide guidance to executives. Many companies are also embedding risk culture from the boardroom down. Directors now demand clear, real-time risk intelligence to drive strategic decisions. The overall message: human-centric technology can empower risk managers, not supplant them. The hope is that as risk management becomes as dynamic as the threats faced, enterprises will be better prepared to withstand shocks and keep advancing, just as a well-built starship stays on course through turbulent cosmic weather. E-commerce and legal compliance angle. Online retailers and marketplaces are not immune to these risk management trends. In fact, leading e-commerce platforms are beginning to adopt risk scoring and fraud detection systems to protect both their customers and bottom lines. By using AI to monitor transactions for anomalies, such as suspicious buying patterns or potential cyber attacks, e-commerce companies can identify fraud in real time and prevent costly incidents. Vendor and supply chain risk is another area of focus. If a key supplier fails or is compromised, advanced risk tools can alert e-commerce businesses to quickly find alternatives, ensuring customers still get their orders on time. Additionally, regulators are increasingly scrutinizing online marketplaces for issues like data security, privacy, and product compliance. To stay ahead, e-commerce firms are embedding compliance checks into everyday workflows. For instance, verifying that sellers meet legal standards and that cross-border shipments adhere to trade regulations. In an era where a single disruption can ripple through global commerce, these risk and compliance measures will keep online businesses resilient and customers' trust sky high. 3. Real-time B2B payments go mainstream. Instant money transfers shrink settlement times from days to seconds. A new era of warp speed payments has arrived for businesses, eliminating one of the longest-standing friction points in commerce, waiting for funds to clear. This week, the U.S. Federal Reserve reported a milestone in adoption of its FedNow instant payment network, launched 3 years ago to enable instant bank-to-bank transfers 24/7. As of June 2026, over 90% of U.S. banks and credit unions are connected to real-time payment rails, and daily transaction volumes have doubled year over year. For businesses, this means routine B2B transactions like supplier payments, payroll adjustments, and invoice settlements now often finalize within seconds rather than days, dramatically improving cash flow management and reducing the need for costly short-term borrowing. The trend is not just in the U.S. Instant payment systems have become the new normal across many economies, with similar high-speed networks in Europe, Asia, and Latin America helping companies sidestep the delays of legacy wire transfers. Many CFOs compare this transformation to moving from the postal service to email, delivering working capital with unprecedented speed, which is particularly invaluable for small businesses and startups with tight cash cycles. Driving this adoption are both technological innovation and competitive pressure. Banks and FinTech providers are actively encouraging corporate clients to shift to real-time payments through user-friendly platforms and incentives, as they themselves seek new fee revenue streams beyond traditional card networks. Moreover, new features like Request to Pay (R2P) services allow businesses to send electronic payment requests that customers or partners can approve in one click, eliminating paper invoices and checks. Industry observers note that seamless, immediate B2B transactions reshape the economics of payments, reducing reliance on credit cards for business purchases and fostering more direct bank-to-bank commerce. This week's Money 2020 conference in Europe showcased a wave of startups offering invoicing automation and cross-border payment solutions that settle in real time, highlighting how ubiquitous high-speed payment infrastructure is unleashing a new generation of financial tools for enterprises. The expectation now is that money moves as fast as information, said one banking executive, pointing out that companies increasingly schedule their operations and supply chains around instant flows of funds rather than the old 2 to 3 day cycle. The benefits for business and society are promising. Real-time B2B payments improve trust and efficiency across supply chains. Suppliers get paid faster, which can strengthen small businesses and emerging markets that rely on prompt cash flow. Large companies, too, are using instant payments for just-in-time inventory purchases, fine-tuning their working capital management to save on interest costs. Human workers benefit when payroll corrections or emergency disbursements, like insurance payouts or disaster relief funds, reach accounts immediately in times of need. Of course, challenges remain, chief among them ensuring robust fraud prevention on lightning-fast rails. But with advanced authentication and monitoring, experts express confidence that these systems can remain secure. Many in the industry see instant payments as foundational to a more connected world economy, with seamless transactions crossing borders and time zones, a financial network as continuous and universal as the rotation of the Earth itself. E-commerce and legal compliance angle. E-commerce companies and online marketplaces are poised to reap big benefits from the real-time payments revolution, while also confronting new responsibilities. Faster settlement means that merchants can receive customer payments or supplier refunds immediately, improving cash flow and customer satisfaction by speeding up shipping and refunds. In regions with high instant payment adoption, some e-commerce platforms are already offering pay by bank options at checkout that transfer funds directly from buyers' bank accounts in seconds, a potential alternative to card payments with high fees. However, instant irrevocable payments demand robust protections against fraud and errors. Consumer protection laws may need updates to cover faster refunds or dispute resolution in a real-time environment. Online retailers must upgrade their payment compliance systems too, verifying customer identities in real time to prevent transactions from fraudsters and complying with any new government guidelines on instant payment security. The net effect should be positive. By working with payment providers and regulators to establish best practices, the e-commerce sector can harness instant payments to serve customers better while keeping transactions as safe as a guided spacecraft docking. 4. RegTech in high gear as regulations tighten. Compliance automation surges to meet crypto and privacy rule deadlines. This week, financial firms across the globe are racing the clock to deploy advanced RegTech solutions, software, and AI-driven systems for regulatory compliance as a series of major rule changes approach. In Europe, the regulatory spotlight is on the markets in crypto assets, MiCA law, which fully comes into force on July 1, 2026, imposing comprehensive licensing and compliance requirements on any company dealing in crypto assets. With less than a month remaining, hundreds of cryptocurrency exchanges and fintech firms are scrambling to secure licenses before the grace period ends, or risk being forced to shut down their European operations. Many small and mid-sized crypto firms, struggling with the complexity of MiCA's requirements, are urgently adopting specialized RegTech platforms that can automate processes like continuous customer identity verification, transaction monitoring, and real-time risk scoring. Regulators are similarly stepping up their game. In the U.S., the Treasury Department this week issued new guidance under the Genius Act stablecoin law, signaling that payment companies must implement stricter systems to counter illicit finance. The message is clear: to continue operating legally, companies must upgrade their compliance capabilities, and technology is the only viable way to meet the heightened expectations at scale. The RegTech sector, once a niche back-office support field, is now front and center. Investments in compliance technology have surged as executives recognize that automation is essential not just to avoid fines, but to gain a competitive edge. Natural language processing, NLP, tools are being used to scan and interpret new regulations in multiple jurisdictions, automatically mapping new legal requirements to a firm's internal controls. In the realm of Know Your Customer, KYC, and AML, what used to take days or weeks can now be done in seconds by AI, verifying customer identities against global watch lists, analyzing transaction patterns for suspicious activity, and even generating draft suspicious activity reports, SARs, for human review. Compliance teams at banks and fintech companies are embracing these tools to handle soaring workloads without proportional headcount increases. One compliance officer at a multinational bank remarked, "We're moving from periodic checkups to continuous monitoring. Compliance is no longer a one-off project, but a real-time part of doing business." The result is that RegTech has evolved from a cost center to a strategic asset, central to whether a company can scale rapidly in a complex regulatory environment or whether it gets bogged down by manual processes. Underpinning this transformation is an encouraging alignment of technology, regulation, and corporate culture. Regulators themselves are increasingly supportive of innovative compliance approaches, even experimenting with regulatory sandboxes and data-sharing initiatives that encourage the use of machine learning for fraud detection and risk analytics. The hope is that better compliance tech improves financial integrity without unduly stifling innovation or burdening smaller players. Many industry watchers foresee that companies with superior RegTech systems will attract more investment and customer trust. They'll be seen as safer bets. Additionally, by reducing human error and bias through automated checks, these systems can bolster fairness and consistency in how rules are applied. In the long term, some envision a compliance autopilot guiding institutions much like a navigation system guides a spaceship, ensuring they stay on the correct trajectory through the shifting cosmos of global regulations. The journey isn't easy, but the destination, a more transparent and robust financial system, is clearly worth the effort. E-commerce and legal compliance angle. E-commerce and fintech companies handling online transactions face their own set of rising compliance demands. New privacy laws, like updated data protection regulations in various countries, and financial rules mean that even small online businesses must adhere to stricter standards. For example, An e-commerce platform processing digital payments might need to implement stronger customer verification and anti-fraud systems to comply with AML and counterterrorism financing laws that now extend to online marketplaces and payment processors. Similarly, if an e-commerce business experiments with crypto payments or NFTs, it may fall under crypto asset regulations like MiCA, requiring careful consumer disclosures and risk assessments. This has led to a growing market of RegTech services tailored for e-commerce, offering plug-and-play solutions that monitor transactions, protect customer data, and ensure tax compliance across different jurisdictions. The takeaway for online entrepreneurs is clear: compliance can no longer be an afterthought. Fortunately, modern RegTech tools, many leveraging AI, allow even smaller e-commerce firms to automate compliance tasks behind the scenes, so they can focus on serving customers and growing their cosmic enterprise without fear of regulatory surprises. 5. Market infrastructure preps for 24/7 stock trading. Exchanges push boundaries as always-on markets near liftoff. In an unprecedented development, U.S. stock market infrastructure is edging closer to a historic makeover: 24-hour trading for equities. This week, the National Securities Clearing Corporation, NSCC, which underpins the settlement of trades on U.S. exchanges, announced that it will be technologically ready by the end of June to support around-the-clock trading sessions. The move is a crucial step toward a future where investors worldwide could trade stocks at any hour, day or night, aligning Wall Street's clock with the 24/7 rhythm of cryptocurrency markets. Industry enthusiasm is growing. Proponents argue that continuous trading will increase liquidity and allow international investors to participate in U.S. markets more easily during their local business hours. An executive at one electronic exchange hailed it as a natural evolution, saying, "Markets don't sleep anymore. It's time stock trading caught up to the internet age of instant information." Major brokerages are already expanding their after-hours trading offerings, anticipating that full 24/7 access to at least large-cap stocks could become a reality by late 2026. However, bringing the stock market into a perpetual trading cycle raises significant logistical and risk management questions that regulators and exchanges are still working through. One concern is how to handle corporate actions like earnings reports, dividends, or mergers, which have traditionally been announced outside of trading hours to avoid chaos. If markets never close, firms and regulators may need new protocols to pause trading around major announcements or to implement automated circuit breakers at all hours to manage volatility. Clearinghouses like NSCC have reportedly developed faster overnight settlement processes, but some on Wall Street urge caution, noting that continuous markets could amplify short-term volatility and stress human traders and systems that currently rely on downtime. Despite these caveats, momentum toward 24/7 market access appears strong, fueled by technology and competition. If realized, 24/7 trading could effectively erase the line between Wall Street's day and night, a shift as profound for financial markets as extending human activity beyond Earth's day-night cycle is for space explorers. From a broader perspective, the potential dawn of 24/7 stock trading is viewed with both excitement and careful optimism. Investors could benefit from constant access to adjust portfolios in reaction to global events, making markets more efficient and responsive. Financial technology firms are gearing up with platforms and AI-driven trading assistants to help manage the deluge of data and decisions in a non-stop market. And while some fear that smaller traders might be disadvantaged by high-frequency algorithms dominating in the wee hours, regulators are likely to introduce new safeguards to protect retail investors. Ultimately, the push for round-the-clock trading reflects a world more interconnected than ever. From New York to London to Tokyo, markets are entwined. By accommodating all time zones, financial exchanges move one step closer to a truly global, inclusive marketplace, one that never sleeps and serves participants on their own schedules. It's a vision of finance aligning with our 24/7 digital lives, potentially laying groundwork for an era where the sun never sets on the stock market. E-commerce and legal compliance angle. The concept of always-on markets blurs the line between traditional stock trading and the instantaneous gratification of online commerce, something e-commerce companies understand well. If stocks trade 24/7, retail trading apps and platforms, the e-commerce of investing, will need to adapt their user interfaces and support systems for round-the-clock customer activity, similar to how e-commerce websites operate continuously. This comes with regulatory considerations. Investor protection rules may be updated to ensure that retail traders are informed of risks associated with overnight trading and that trading halts or volatility controls are in place to prevent abuse. Online brokerages might also need to bolster their customer service and compliance monitoring, as there will be no off hours to catch fraudulent activity or technical errors without impact. Yet the positive spin is that 24/7 markets could democratize access. Anyone with an internet connection can trade at their own convenience. Much like e-commerce opened up shopping beyond mall hours, round-the-clock trading could empower individuals globally to participate in wealth creation on their terms, provided that adequate guardrails keep this space safe and fair for all. 6. FinTech unicorn ramp soars with $750 million boost. Corporate spend management startup reaches stratospheric $44 billion valuation. The FinTech fundraising frenzy hit new heights as Ramp, a fast-growing startup specializing in corporate spend and cash flow management, announced a staggering $750 million capital raise. The funding round, led by prominent investors including Iconic Capital, GIC, Singapore's sovereign wealth fund, and major Wall Street players, values the New York-based company at $44 billion, nearly triple its valuation from just a year ago. This makes Ramp one of the world's most highly valued private fintech companies, underscoring investor confidence in the booming CFO tech sector. Founded in 2019, Ramp initially disrupted corporate credit cards and expense reports with an AI-driven platform that automates how businesses track and control spending. Now it has evolved into a broader finance automation suite for companies, offering everything from real-time spend analytics to predictive cash flow tools that help finance teams find savings. With over 70,000 business customers, including high-profile names in tech and retail, Ramp has been riding a wave of demand from enterprises looking to streamline finances in a competitive environment. This enormous funding injection brings Ramp's total equity raised to more than $3 billion and will fuel the company's global expansion and product development. Ramp's executives confirmed plans to extend their reach overseas, with new offices and market launches in Europe and Asia slated for later this year, an ambitious move as they bring their corporate card and expense software to international clients. Part of Ramp's rapid growth strategy has been through acquisitions. Earlier this year, it acquired a travel booking platform to integrate corporate travel spending and a European payments firm, strengthening its service portfolio. Analysts note that Ramp's sky-high valuation reflects not just its own success, but a broader trend. Investors see huge long-term opportunity in enterprise financial software that reduces costs and adds intelligence to business operations. In an era where companies are cautious about spending and open to automation, Ramp's promise to save businesses money by optimizing every dollar they spend resonates strongly. The latest funding round's participation by heavyweights like Goldman Sachs and Morgan Stanley signals that even traditional finance believes this startup's AI-centric approach could redefine how corporations manage money. For those on the front lines of corporate finance, Ramp's meteoric rise is inspiring, a sign of a positive future for technology that empowers financial teams. The platform's AI algorithms have been credited with uncovering wasteful expenditures, flagging duplicate subscriptions, and even negotiating better vendor prices, effectively acting as a digital financial advisor in the background. Finance chiefs adopting such tools say they can reallocate savings to strategic investments or hiring, enhancing their company's agility. Ramp's founder and CEO lauded the funding as validation of their mission to reinvent financial operations for organizations, so people can focus more on growth and innovation than paperwork. This optimistic vision aligns with a broader shift. CFOs are increasingly seen as strategic navigators, not just number crunchers. And they're demanding real-time insights and automation to steer their companies through a rapidly changing economic landscape. With its cash war chest, Ramp is now poised to not only scale up, but potentially to acquire smaller rivals, part of an ongoing consolidation in the financial software industry as companies race to offer all-in-one solutions. Ultimately, the excitement around Ramp suggests that the future of corporate money management is bright, automated, and firmly oriented toward helping people make smarter decisions with their financial resources. E-commerce and legal compliance angle. E-commerce startups and online sellers stand to benefit from the rise of expense management and cash flow optimization tools like Ramp. Many digital retail businesses, often founded by creative entrepreneurs, initially struggle with financial admin, chasing receipts, handling reimbursements, and keeping track of budgets across marketing, inventory, and operations. Modern finance automation platforms can significantly ease this burden by aggregating expenses, auto-categorizing spending, and flagging anomalies, such as over-budget campaigns or duplicate vendor charges. Besides convenience, these tools enhance compliance and audit readiness for e-commerce firms, automatically creating clear trails for taxes, sales reporting, and regulatory filings. For example, a small online fashion retailer using such a platform can more easily produce accurate financial statements and comply with tax regulations in multiple states or countries. However, experts advise that digital businesses integrate these systems carefully, ensuring employees are trained and oversight remains in place. As regulatory scrutiny on FinTech and e-commerce grows, especially around accounting accuracy and fraud prevention, combining human judgment with these AI-driven tools can help online companies stay compliant, agile, and ready for the next chapter of growth, whether on Earth or beyond. 7. Global supply shock tests risk preparedness. Middle East turmoil sparks corporate resilience push. A geopolitical jolt this quarter has put enterprise risk management to the ultimate test, and the outcome is a tale of both caution and resilience. A crisis in the Middle East has severely disrupted energy shipments through the Strait of Hormuz for over 2 months, sending oil and gas supplies plummeting and prices skyrocketing worldwide. This unexpected shock, one of the worst supply chain disruptions in recent memory, caught many companies off guard and revealed vulnerabilities in global just-in-time operations. Businesses reliant on Middle Eastern oil scrambled to find alternative fuel sources, airlines hedged and cut flights as jet fuel costs spiked, and industries from chemicals to shipping reeled from shortages. According to a risk industry report, some firms that had bet on stable prices and lacked robust contingency plans suffered hefty losses. One analysis indicated that certain Asian trading desks with large short positions in jet fuel faced losses up to $100 million as margin requirements jumped more than 500% during the turmoil. The stock market briefly wobbled on this news, with energy sector shares surging and transportation stocks dipping, reminding investors that geopolitical events can send shockwaves across portfolios. Yet amid the chaos, stories of corporate resilience have emerged, highlighting the value of advanced risk planning and nimble decision-making. Several global manufacturers and retailers that had invested in scenario planning software and diversified suppliers weathered the storm far better than peers, quickly shifting sourcing to unaffected regions, tapping into strategic fuel reserves, or hedging commodity exposures through automated risk dashboards. One logistics CEO credited their AI-driven risk alert system for issuing early warnings about the brewing crisis, enabling them to reroute shipments and communicate transparently with customers about delays. Similarly, companies with strong business continuity plans, essentially economic life support systems, manage to keep operations running and meet key commitments despite the surrounding volatility. These examples have not gone unnoticed. Observers say the shock is serving as a wake-up call in boardrooms globally, prompting renewed investment in enterprise risk management tools and training. The sense is that this challenge, while grave, has accelerated innovation. Much as the space race drove rapid technology advancement in the 20th century, today's global uncertainties are pushing companies to innovate new methods of resilience and collaboration. Leaders express hope that the lessons learned will make the global corporate ecosystem sturdier and more compassionate. Business resilience is, at its core, about protecting people, employees, customers, and communities from harm when disasters strike. The crisis has spurred unprecedented cooperation between governments and companies, such as data sharing initiatives to monitor fuel inventories and market circuit breakers to curb panic buying. There is also a new appreciation for intangible benefits, companies that communicated proactively and fairly with customers during the shock, for example, avoiding price gouging and offering flexible terms, have already seen brand loyalty strengthened. Risk experts argue this exemplifies how doing right by stakeholders in tough times can pay dividends in the long run. As shipping routes gradually stabilize and markets normalize, the prevailing sentiment is cautious optimism. With better risk technology and strategic foresight, businesses around the world are more determined than ever to build agile supply chains and robust contingency plans, not just to survive the next crisis, but to keep human progress on track even when the unexpected strikes. E-commerce and legal compliance angle. E-commerce and retail companies have felt the ripple effects of global supply chain shocks as well, facing delayed products, higher shipping costs, and volatile prices. This has led many online retailers to re-examine their risk and legal contingency plans. For example, e-commerce businesses are negotiating flexible supply contracts that include robust force majeure clauses, which provide legal cover if a supplier fails to deliver due to geopolitical disruptions. Online marketplaces are also investing in inventory risk analytics to predict which products might be affected by global events, like a regional conflict, and adjusting their stock or pricing strategies proactively to avoid empty shelves or sudden price jumps. Regulatory bodies, meanwhile, have warned companies against unfair price hikes during crises, so e-commerce platforms need to ensure they comply with price gouging laws and maintain transparent communication with customers. The big picture lesson is that resilience and compliance go hand in hand. Online retailers who build more resilient supply chains and clearly outline policies for disruptions not only stay within the law, they also earn consumer trust, turning challenges into an opportunity to highlight their commitment to customers' needs. 8. FinTech M&A. Airwallex acquires LeapFin. B2B payments powerhouse expands with AI accounting deal. Airwallex, a global business payments and financial platform, announced its acquisition of LeapFin, a California-based fintech startup specializing in automated revenue accounting. The deal, financial terms undisclosed, marks Airwallex's second acquisition this year, following its purchase of a South Korean payments firm in January, as the company accelerates its worldwide expansion. LeapFin's technology uses artificial intelligence to convert huge streams of transaction data into standardized, audit-ready financial records, effectively automating the labor-intensive process of revenue reconciliation. Airwallex's CEO, Jack Zhang, stated that bringing this capability in-house closes the loop on the entire financial lifecycle for their customers, meaning Airwallex can now offer a one-stop solution from accepting payments to managing the back-end accounting. Industry analysts say this is a savvy expansion for Airwallex, which started as a cross-border B2B payments provider, but is evolving into a full-fledged financial infrastructure platform for businesses. By integrating LeapFin and its talented team, who will join Airwallex, the company signals its commitment to delivering seamless, end-to-end financial workflows. This acquisition speaks to a larger trend of consolidation in the fintech infrastructure space. Growing B2B fintechs are racing to build comprehensive suites for business finance, spanning payments, treasury, lending, and now accounting, in order to serve enterprise clients who prefer integrated solutions over juggling dozens of point providers. Airwallex is one of the frontrunners in this space. Founded in 2015 in Melbourne, it has grown explosively and now processes over $260 billion in annual transaction volume for more than 250,000 businesses worldwide. Flush with funding from global investors, the company recently announced plans to invest $1.1 billion across Europe, the Middle East, and Africa over 5 years to support its growth, including building a major engineering hub in London. With Leapfin's capabilities on board, AirWallex can help CFOs and finance teams get real-time visibility into their revenue streams across various payment methods and currencies. Observers note that this combination of payments and accounting tech is timely. As businesses adopt real-time payments and global e-commerce expands, the lines between processing a payment and recording it accurately are blurring. Platforms that can do both may win outsized market share. Customers and small businesses stand to benefit as B2B FinTech firms grow and integrate. A mid-sized online retailer, for instance, could potentially use AirWallex to collect payments from global customers, convert currencies at low cost, pay overseas suppliers, and have all those entries automatically reflected in their accounting system, all through one platform. This simplifies operations and reduces errors from manual data transfers. The integration of AI also means new value-add services, for example, proactive cash flow forecasting, automated tax calculations, and compliance alerts built into the platform. Confidence in such tools is rising as success stories emerge. Companies using unified finance platforms often report faster financial closes and fewer audit issues, giving them more time to focus on growth. With deals like this, the FinTech industry continues its optimistic trajectory of building ever more powerful tools for businesses, akin to constructing an interconnected global financial station where everything from launch, payment initiation, to landing, financial reporting is handled under one roof. E-commerce and legal compliance angle, online merchants and digital marketplaces are a key constituency for FinTech platforms like AirWallex, and they could see immediate benefits from this kind of integration. Revenue recognition and accounting compliance are traditionally headaches for e-commerce sellers, especially those dealing with multiple payment methods, credit cards, digital wallets, buy now, pay later, etc., and cross-border transactions. With the integration of Leapfin's AI-driven accounting engine, e-commerce businesses might soon have a plug-and-play solution to automatically transform their sales data into proper financial statements that align with GAAP/IFRS standards. That means easier tax filings, reduced errors, and a stronger audit trail, even as transactions flow in from all over the world. Still, experts caution e-commerce companies to maintain oversight. Relying on automated systems doesn't absolve a business from responsibility for compliance. Merchants should work closely with these FinTech providers, ensuring data accuracy and understanding how the AI makes decisions. In the end, seamless payment to accounting services can be a boon, allowing growing online businesses to scale confidently and focus on customers, while staying on the right side of financial regulations amid increasingly global operations. 9. AI meets compliance. FS launches Financial Crimes Agent. New RegTech AI slashes anti-money laundering investigation times. A cutting-edge development in RegTech, FIS, a leading global financial technology provider, announced a collaboration with AI research firm Anthropic to roll out an agentic AI system for bank compliance departments. The first offering, called the Financial Crimes AI Agent, uses Anthropic's advanced Claude AI to help banks automatically investigate and detect suspicious transactions in minutes rather than days. According to FIS, the AI agent can ingest data across a bank's internal systems, from transaction ledgers to customer profiles, and cross-reference it against known money laundering typologies. By swiftly assembling evidence and flagging the highest risk cases for human review, the system aims to massively reduce the time and cost of identifying fraudulent activity, freeing up compliance officers to focus on judgment and decision-making. Early adopters of the system include BMO, Bank of Montreal, and Amalgamated Bank, which have been piloting the technology ahead of a broader release set for the second half of 2026. Analysts say this marks an important step in how the financial industry is adapting AI for critical, sensitive tasks, not just giving advice, but actually taking on work traditionally done by humans in a carefully controlled way. Crucially, FS emphasizes that the AI agent operates under strict human oversight and transparency, a key requirement in regulated finance. Every recommendation the AI provides is traceable back to its source data and human investigators remain the ultimate decision makers, ensuring a human-in-the-loop safeguard. This approach addresses regulator concerns about adopting AI in compliance. Last month, U.S. officials noted that sophisticated AI systems must have robust governance to avoid creating blind spots or unintended bias. By building this solution jointly with an AI safety-focused firm like Anthropic, FS aims to strike the right balance between innovation and trust. The financial crimes AI agent is just the beginning. FS has outlined a roadmap to develop similar agents for credit underwriting, customer onboarding, and fraud prevention using the same underlying platform. The excitement in the compliance world is palpable. One senior bank executive involved in the project enthused, "It's like having an extra team of analysts who never sleep. The AI combs through billions of transactions in real time, but we stay in control of what happens next." The mood is optimistic that AI, properly harnessed, will enhance the capabilities of human compliance teams and help them protect the financial system more effectively than ever. The deployment of AI in compliance also highlights a broader industry commitment to improving financial integrity and efficiency simultaneously. As financial crimes become more sophisticated, with criminals leveraging technology for fraud or money laundering, it's fitting that AI itself is being used to fight back. There's also a social benefit. By reducing false positives and tedious manual work, bank personnel can tackle real threats faster, potentially preventing harm to vulnerable communities that might be targets of fraud. Observers note that the era of compartmentalized, sluggish compliance processes is fading, replaced by agile systems that combine machine speed with human judgment. In this way, compliance isn't about checking boxes, it's about intelligently safeguarding customers and markets. The sentiment across FinTech this week has been hopeful. If such AI agents truly deliver on their promise, they could usher in a new standard of trust and safety in finance. The financial world is watching closely, seeing if this ambitious initiative can serve as a model for other industries, like insurance or healthcare, where compliance is critical. For now, FIS's venture with Anthropic is already being hailed as a milestone on the journey to smarter, always-on governance, a kind of digital co-pilot for the complex voyage of modern financial services. E-commerce and legal compliance angle. E-commerce platforms and payment processors can draw inspiration from banks' embrace of AI and compliance. Online marketplaces and fintech apps face their own challenges with fraudulent transactions, seller scams, and suspicious activities that threaten trust. By using AI-powered monitoring tools, similar to those FS is pioneering, e-commerce companies could identify risky behavior by sellers or buyers much more quickly, for example, detecting fake reviews, account takeovers, or unusual purchasing patterns. Already, some large marketplaces have begun investing in AI for automated content moderation and transaction monitoring. However, just like in banking, human oversight remains key. E-commerce firms should ensure that any AI-driven enforcement actions, such as blocking a merchant or refunding a customer, are transparent and can be manually reviewed. On the legal front, regulators are paying attention to how businesses use AI to make decisions. For instance, consumer protection agencies may issue guidance on fairness and accountability for AI in fraud detection or credit decisions. The bottom line: smart compliance tech can help e-commerce scale trust alongside growth, making online spaces safer and more reliable. But these tools should be implemented thoughtfully, with humans guiding the algorithms to uphold fairness and accuracy. 10. Real-world asset tokenization takes off. Institutional markets embrace blockchain as traditional assets go digital. The line between traditional finance and the world of blockchain is dissolving as institutional investors ramp up real-world asset tokenization initiatives. In a sign of this emerging mainstream acceptance, a consortium of major banks and asset managers announced this week that they have successfully executed a series of live trades involving tokenized government bonds and money market fund shares. The digital tokens, representing claims on real financial assets, were issued on a regulated blockchain network and traded among participants with near-instant settlement, a process far faster than the typical two-day standard for these assets. This follows on the heels of multiple similar projects globally. In the European Union, recent regulatory clarity under MiCA has emboldened firms to start rolling out tokenized versions of real estate funds, carbon credits, and even fine art. Meanwhile, financial giants in the US and Asia are launching digital asset pilot programs. Just last month, one of Wall Street's largest investment banks unveiled a platform to offer tokenized private credit assets to its institutional clients. Market infrastructure providers, including stock exchanges and clearinghouses, are also joining the fray. Some are adapting their systems to support blockchain-based settlement, betting that the future of trading will involve on-chain assets alongside traditional ones. The reasons behind the tokenization trend are compellingly pragmatic. By representing real assets on distributed ledgers, institutions can achieve faster, cheaper, and more transparent transactions. For example, settlements that once took hours or days can wrap up in seconds, reducing counterparty risk and freeing up capital that would otherwise be tied down. Tokenized assets can also be traded 24/7, beyond the confines of traditional market hours, aligning with a global investor base that doesn't sleep, especially as we extend our reach beyond one time zone, or even one planet. In addition, these digital assets can incorporate programmable features. Imagine bonds that automatically distribute interest payments via smart contracts, or real estate tokens that provide fractional property ownership with built-in compliance checks. The technology opens the door to making illiquid assets more liquid. For instance, a private equity stake or a piece of fine art could be made tradable, unlocking value for investors who previously had to wait years to cash out. With tokenization's potential to democratize investment opportunities and shave inefficiencies, it's no wonder venture capital investment in blockchain market infrastructure has surged. 2026 is on pace to set records for funding into firms that specialize in asset tokenization services. Financial regulators, initially cautious, are now increasingly supportive of these experiments as long as proper safeguards are in place. Central banks and watchdogs around the world are actively exploring how to oversee tokenized markets, often by applying the same principles that govern traditional securities. There are ongoing discussions about ensuring consumer protections, preventing illicit use, and maintaining market stability as token volumes grow. But the mood among industry leaders is optimistic. They frequently invoke the historical analogy of how electronic trading revolutionized stock markets decades ago, suggesting that tokenization is simply the next evolutionary step. For ordinary investors, the full impact might not be felt immediately, but over time tokenized assets could lead to lower fees and new ways to invest. Imagine being able to buy a tiny share of a skyscraper or a piece of a famous painting as easily as buying a stock. Engineers and entrepreneurs are also excited. They see these developments as building blocks for future financial systems that could one day seamlessly integrate Earth's markets with emerging digital economies, perhaps even beyond Earth, if human commerce ever extends to orbit. For now, the tokenization of real-world assets stands as a beacon of innovative progress, promising a future where financial opportunity is as limitless as the cosmos and accessible to a broader swath of humanity. E-commerce and legal compliance angle. While asset tokenization is primarily transforming high finance, forward-thinking e-commerce and retail companies are watching closely for downstream opportunities and regulatory implications. For example, e-commerce giants have been exploring blockchain tokens for supply chain tracking and loyalty rewards. If these tokens become classified as digital assets or securities, companies will need to navigate compliance with token issuance regulations. A robust legal framework for digital assets, like MiCA in Europe, provides guidelines that may eventually apply to certain aspects of e-commerce, such as customer reward tokens or gift card systems that operate on blockchain. Online marketplaces might also benefit from tokenization indirectly. If trade finance instruments or inventory assets are tokenized, smaller merchants could more easily secure funding by selling tokenized invoices or goods in advance, injecting liquidity into e-commerce ecosystems. Still, as with any new financial technology, regulatory oversight will be crucial. E-commerce firms venturing into tokenization must work with legal teams to ensure any tokens they create or accept, even as part of promotions, comply with securities and consumer protection laws. Ultimately, as traditional finance explores tokenization, the trust frameworks built around it may trickle into online commerce, enabling innovations like safe and regulated digital marketplaces for intangible assets. Disclaimer: this report is for informational purposes only. It does not constitute legal, financial, or medical advice. All news stories discussed are purely informational and should not be construed as advice or recommendations. Do not make financial or legal decisions based solely on this content. Always consult appropriate professionals for advice specific to your situation. Video description. In today's news report, June 6, 2026, we dive into 10 groundbreaking stories at the intersection of finance and technology. From corporate treasurers embracing stablecoins for ultra-fast cross-border liquidity, to banks battling fraud with cutting-edge AI compliance agents, to stock exchanges preparing for 24/7 trading, we cover it all. You'll learn how enterprise risk management is evolving with real-time AI insights that help companies weather global shocks, how instant payments are transforming B2B commerce, and how consolidation and innovation in FinTech are reshaping everything from regulatory compliance to market infrastructure. Join us for a futurist, optimistic look at how these developments, laced with a bit of space-age perspective, are ushering in a brighter, more connected financial world. Remember, this news is informational and not legal/financial advice. Video tags: FinTech, stock market, corporate treasury.